Index funds are a really great and easy way to invest if you know how to avoid the traps that can eat into your profits. So let's get into the 5 most common index fund mistakes, and make sure you watch to the very end because mistake number 5 is the one I see investors making the most often. One of the most crucial yet overlooked aspects when it comes to index funds is fees and expenses. You may think that index funds being passively managed are inherently low cost, and while this is generally true compared to actively managed funds, fees can still vary significantly between index funds. Fees matter because even small differences in expense ratios can have substantial impact on your long-term returns. Let me show you with a simple example. Imagine that you invest $10,000 in 2 different index funds, one with an expense ratio of 0.05%, like Fidelity Bond Index, FIPDX, and another with an expense ratio of 0.50%, like the Schwab Balanced Fund, SWOBX. Over 20 years, that seemingly small difference between expense ratios can add up and result in a significant variation between the amount of money that you end up with. Going back to our example, an index fund with a 0.50% expense ratio like the Schwab Balanced Fund could end up costing you an additional $45 a year on a $10,000 investment compared to a fund with a 0.05% expense ratio like the Fidelity FIPDX fund. Over decades, this amount can end up being thousands of dollars in lost returns. But fees aren't just limited to the expense ratio. You also want to consider additional costs like trading fees, management fees, and any other hidden fees that may not be immediately obvious. To avoid this mistake, always compare the expense ratio of the index funds you are considering. Look for funds with lower fees that still match your investment goals and your risk tolerance. It's not a hard and fast rule, but I personally like to look for index funds with expense ratios of under 0.20%. Overall, by keeping your fees and expense ratios in check, you'll be able to maximize your growth and make sure that more of your money is going toward working for you rather than going toward unnecessary fees and expenses. Another big trap that investors fall into with index funds is chasing performance. Many people make the mistake of investing in a fund based on its most recent performance. But investing based solely on most recent gains means that you have a short-term strategy with index funds rather than having a more disciplined, longer-term strategy. For example, if you notice that an index fund has been doing really well in recent times, you may be tempted to jump on board and start investing too. However, you should always note that past performance is not a reliable indicator of future results. The key issue here is that high performance in the short term can be misleading. Index funds can soar due to a number of different conditions, for example, market conditions or sector-specific factors. By the time you invest in this index fund based on its performance, it might actually already be on the downturn. And this is an example of buying high and selling low, which is the exact opposite of a successful investment strategy. Additionally, another big issue with this is that focusing on short-term performance can lead you to frequently switch between funds. This can increase your transaction costs and also result in poor decisions. Each time you buy or you sell index funds, you could incur additional fees or taxes which could eat into your profits like we just discussed. To avoid this, you really need a well thought out investment strategy that aligns with your financial goals, your risk tolerance, and your time horizon for retirement. Choose index funds that align with your long-term strategy and then just stick to them without being pulled by the most recent high-performing funds. By focusing on your own personal investment strategy and then just blocking out all the temptation to chase after short-term gains, you will be in a better position to have consistent long-term growth. Mistake number 3 is not rebalancing. Rebalancing your portfolio is an important part of your investment strategy that cannot be skipped. Rebalancing involves adjusting your portfolio back to its original or your desired asset allocation. For example, if your desired asset allocation is 60% stocks, 40% bonds, but due to market fluctuations, your portfolio is now at 70% stocks, 30% bonds, then rebalancing for you would involve selling some of your stocks and buying more bonds to bring back that allocation to your desired state. Rebalancing is important because as markets change, different investments in your portfolio will perform differently. Without rebalancing, you might end up with a portfolio that is much riskier than you intended or that you're comfortable with. This is especially true if one type of investment ends up growing way faster than another type. There's no need to go overboard with rebalancing. Rebalancing maybe quarterly, semi-annually, or annually should be enough. However, if there are significant changes in the market, or if your investments have shifted a lot from your original plan, then rebalancing more often could be beneficial for you. Mistake number 4 is ignoring taxes. So while index funds are often praised because of their low fees and their broad market exposure, ignoring the tax implications can lead to unexpected costs. Index funds generate what are called taxable events through dividends and capital gains. So let me break this down. First, let's start off with dividends. When an index fund distributes income from its underlying stocks to you, its shareholder, it comes in the form of a dividend. And there are 2 different types of dividends which you should be aware of. First are qualified dividends. These are dividends paid from U.S. companies or qualified foreign companies on stocks held for a specific period. Qualified dividends are taxed at the long-term capital gains rate, which is typically lower than the ordinary income tax rate. This can result in a lower tax bill and more money staying in your investment account. Then there are also non-qualified dividends. These might come from investments in certain foreign stocks or from short-term holdings. Non-qualified dividends are taxed at your ordinary income tax rate, which can be higher and potentially result in more money being taken away from your returns. And then there are also capital gains. So when you sell your index fund shares for more than you paid, then you incur a capital gain. If you hold the shares for more than a year before selling, then it is considered to be a long-term capital gain and it is taxed at a lower rate. If you sell within a year, it is considered to be short-term and is taxed at a higher rate, which could significantly impact your returns. To avoid any unpleasant surprises, it's important to plan for these tax implications. I highly recommend that you invest using tax-advantaged accounts like your IRAs or your 401k to defer or even eliminate some of these taxes. Also, be strategic about the timing of when you buy and sell your index fund shares so that you can minimize your tax liability overall. Another highly common mistake I see investors make with index funds is investing in multiple funds that essentially do the same thing. These are funds that may track the same indexes or invest in the same sectors. Index funds are designed to provide you with broad market exposure, but when you invest in overlapping funds, this reduces the benefit of diversification. For example, if you invest in 3 index funds that all track the S&P 500, you're essentially just investing in the same 500 companies multiple times. This doesn't give you any extra diversification, and it just means that you are exposed to the same risks more than once. An example of this is that there are 2 very popular index funds among investors. One is Fidelity's FXAIX, which tracks the S&P 500, and another is Vanguard's VFIX, which also tracks the S&P 500. These funds are both tracking the same index. They have similar compositions, and you don't need to invest in both. You're better off just choosing one. Overlapping investments can also skew your portfolio's risk profiles. If one sector or region starts to perform poorly, having multiple funds with heavy exposure can really magnify your losses instead of spreading them out. This can lead to unintended risk and can make your investment portfolio more volatile than you expected. To avoid this mistake, focus on choosing index funds that offer distinct exposure, maybe to a specific geographical region, asset classes, or a sector. For example, combining a US stock index fund and international stock index fund and a bond fund will give you a good mix of diversification in your portfolio. If you want to learn how to build your own investment portfolio using tried and tested investment strategies, then make sure you click the video on the screen right now.